In a major development over the weekend, President Trump announced a significant trade deal with the European Union, marking a significant shift in bilateral relations. The agreement includes a 15% tariff on EU goods entering the US, along with substantial EU purchases of US energy and military equipment. The deal also plans for $600 billion in investments in the US by the EU. Following this announcement, analysts have shared their insights on the potential impact of this deal. Holger Schmieding, chief economist at Berenberg Bank, London, views the agreement as an end to the crippling uncertainty and a modestly positive sign for equity markets. However, he notes that it is still a bad outcome compared to pre-trade war conditions. He predicts that the US will bear a heavy price in terms of higher consumer costs and lower trend growth due to Trump's protectionist policies. Jacobsen, chief economist at Annex Wealth Management, Brookfield, Wisconsin, acknowledges that this is President Trump's biggest deal so far in terms of trade, but emphasizes that the EU represents less volume compared to other trading partners like Mexico, China, and Canada. He also highlights that settling for an average 20% tariff rate is better than the initial threats of 25%, but still higher than the 2024 tariffs of 2.5%. Hasain Malik, strategy head of equity research at Tellimer, Dubai, and Michael Brown, senior research strategist at Pepperstone, London, both agree that the headline 15% tariff is a relief for investors, particularly those in European manufacturing assets. However, they caution that the devil will be in the details, with metals being one area of potential confusion. Winograd, chief economist at AllianceBernstein, New York, compares this deal to the recent one reached with Japan, stressing the need for both sides to adhere to the terms of the agreement. He finds comfort in the fact that a deal is better than no deal from a market perspective. Meckler, partner at Cherry Lane Investments, New Vernon, New Jersey, sees this deal as being in line with the one reached with Japan, and assumes investors will view it positively. However, he cautions about the potential for increased inflation due to higher tariffs. He also notes that the administration may have begun to address balance of trade issues, but questions whether using tariffs as a means to do so is beneficial for the global economy. With these insights in mind, it appears that while this deal brings some relief and clarity on the EU-US trade front, there are still concerns about potential impacts on consumer costs, trend growth, and inflation. It remains to be seen how markets will react when they open for the week.